Welcome to this week's economic podcast from Interactive Brokers. My name's Andrew Wilkinson, and I am joined as ever ahead of the FOMC meeting by CIO and founder at Rareview Capital, Neil Azous. Welcome, Neil. How are you?
I'm good. Thank you for having me, Andrew. Always great to be here with you.
We're recording this a couple of days in advance of the September 17-18 meeting, and it's widely anticipated that the Fed will begin the long-anticipated series of interest rate reductions. Neil, can you frame for us why the pendulum has moved to where it is, and what's the market telling us now?
Sure, Andrew. All right, I'll just touch on the three major components of the meeting and what the market's saying. So first, the interest rate. Second, the summary of economic projections, also known as the SEP or the SEP. And then finally, one brief comment on quantitative tightening or QT. So regarding the interest rate, Andrew, the market's pricing in, I believe, 10 interest rate cuts of 0.25% each at each meeting between now and the fall of 2025. So said differently, the market's pricing in around 2.5% of cuts from that current Fed effective rate of 5.33 down to around 2.9% over the next year or so. And now, Andrew, I guess to answer your question, how do you think about that path in the prism? And to me, it's about the pace of cuts driven by the degree of weakness in employment, whereas the absolute level of where the Federal Reserve will end that cutting cycle is more predicated on inflation. So currently, Andrew, the market's saying that the risk of the Fed cutting a small amount is significantly less than cutting a large amount due to the uptick in unemployment and the downtick in inflation. So here at Rareview Capital, we don't really deal in absolute forecasts, but we are very mindful that the risk factor is heavily skewed towards a higher unemployment rate. Let me just give you an example of what I mean by that. So I think soup to nuts, after the recent 0.9% gain in the unemployment rate, the historical hit rate on that metric continuing higher is 100% over the last 75 years. So it's hard to argue against something that has 100% efficacy rate. So why does that matter for the path of rates over the next year or so? Because historically, the Fed cuts the interest rate around 2.4 times faster than they hike it.
Mm-hmm.
Secondly, they have actually never cut slower than they hiked, which is usually due to being in response of a financial accident that they created. And then finally, you just have to be mindful that in the recent hiking cycle, they did increase interest rates by 0.75% 4 times in a row. And so who's to say that they could do the opposite of that? So Andrew, the market's pricing the Fed to get back to its neutral rate or the level that the economy is running too hot or cold by December 2025 or 15 months from now. While that seems fast, it's pretty much in line with past cycles. And just to be blunt or frank about it, that's just how the process works. It's not really rocket science. They're just moving on, Andrew, to the second major component of the meeting. They call it the summary of economic projections or the SEP. As a reminder, those projections are updated quarterly. So the last update we got was in June. And back then, the Fed raised its inflation forecast by just 0.2% for this year and 0.1% for next year. And that was a mechanical shift to reduce the median amount of cuts expected this year down from 75 to 25 basis points, and then a total through next year to 125 basis points of cut from 150. Since that time, inflation has trended lower and unemployment has trended higher. This time around, the Fed's going to backtrack to where they were last spring, indicating a minimum of probably 75 basis points of cuts for the remainder of this year and somewhere between 75 and 100 basis points of cuts in 2025. Another way to say that, Andrew, they're just going to mark to market their forecast closer to what the market is pricing. And that should be no surprise because in a hiking cycle, the Fed forces the market's hand, and in a cutting cycle, the market forces the Fed's hand. And that's what's happening here. And then just one brief comment, Andrew, to conclude on quantitative tightening. As a reminder, the pace of the balance sheet reduction was downshifted at that May FOMC meeting just a few months ago. So we wouldn't be surprised if the Fed reduced QT further at next week's meeting for no other reason that there's been enough time since their last downshift. And if so, on the margin, we just look at that as being incrementally negative for the US dollar, incrementally positive for US treasuries. And I suppose it's good for US bank stocks as less liquidity is drained from the system. That's the backdrop for the Federal Reserve meeting, Andrew.
Very good. Neil, we'll come back to curve disinversion and to fixed income in a moment, but while you're here, I want to get your take on very recent events. What do you make of things like the yen carry trade unwind that so ungraciously slapped the Japanese stock market and by development the rest of the world's stock markets?
My view, Andrew, is to look at the forest for the trees and not get fixated on one tree, such as the yen carry trade. For example, it's not just the yen carry trade unwind. There was index versus single stock dispersion trade unwind globally. The VIX, as you remember, rose from around 15 to 65 in a
Mm,
record speed. The NASDAQ versus the Russell 2000 saw a double digit performance rotation.
mm,
And then, of course, the two major ones most recently, the US Treasury yield curve turned positive after being inverted. And finally, I think a really important one for portfolio construction, the stock bond correlation flipped back to negative on a rolling basis for the first time in a couple of years. I think the key point overall, Andrew, is that risk events tend to cluster. And when they have these 5 to 7 standard deviation moves, like we've seen over the last 6 weeks in key market relationships, it signals that the forest has spoken, not one tree like the Japanese yen.
right.
And the forest is basically saying that the Fed is too tight, they're behind the curve, and they need to cut interest rates. That's my take on it.
Right. Very good. Let's get back to the curve disinversion. You just referenced that a moment ago. It's about time, isn't it? What do you make of that? This is for the audience. We typically talk about the twos tens yield curve. It's been negative for such a long time, 2-3 years now, and it finally poked its head back into a normal positive shaped curve. What do you think, Neil?
Yeah, that's right. So I'll go with what you just said. I'll reference the 2-year, 10-year US Treasury yield curve as the most generic representation. And the first thing I know is the degree of the starting point that you just highlighted. The yield curve was the most inverted ever during this recent interest rate hiking cycle. That's noteworthy in itself. The second noteworthy observation is that it was the longest yield curve inversion in history. I think it's lasted exactly around 800 days, and it inverted on July 1st, 2022. So that's a pretty dang long time to remain in that setting. Therefore, I guess my starting point is I'm pretty open minded about what could come next, how fast whatever comes next could come, and at what magnitude. And here's what I mean by that. It's not really when the yield curve inverts like it did 2+ years ago that a recession follows. It's when it disinverts that a recession is forthcoming.
Right.
It's just a question of when, how deep, if you really believe in the yield curve being a key indicator. So, for example, Andrew, I think if you look back at 15 or so yield disinversions going back to the 1960s or maybe 1962 specifically, the median time to a recession after the yield curve disinverts is around 7 months. So we have some time. And to be fair, since we have 15 of these examples or disinversions, there are several instances where the economy was already in a recession when it disinverted, or it took as little as 4 months, or really as long as almost 4 years. I think it was like 47 months, if I remember correctly. There's a wide sampling, but my view is you should be on alert for a recession in the intermediate term if you respect this indicator, and that you should be mindful that the major macro relationships can be affected or impacted by that, such as growth versus value, or equal versus market cap weighted, or large versus small cap. Relationships like that you need to pay attention to for structural changes.
So, given that the Federal Reserve is about to make the first cut in years, from a perspective of a bond buyer, are you missing performance if you buy now?
That's a pretty fair question, Andrews, because bond yields, I believe, have come down between like 1.2 and 1.4%, depending on the maturity over the summer. So a lot of performance has already been generated. This is how we think about that question here at Rareview Capital, or how we construct portfolios thinking about that. So we just break the event into 3 phases, or the interest rate cutting cycle into 3 phases. And the percent of that US Treasury yield change during each phase, Andrew, is very different. In the first phase, which is from the last hike, so July 25th, 2023, to the first cut being next week, about 30% of the excess return in US Treasuries over the entire interest rate cycle happened between that last hike and the first cut. We just had that. Theoretically, if you remained in cash or cash-like instruments, you missed the first 30% of the move or that entire phase one. But don't be deterred. Looking forward, you have the second phase, which is next week or the first cut down to the neutral rate, right? That equilibrium rate of the economy, not too hot or too cold. And in this instance or this phase, you get like a small portion of the return, around 9% or so. That's predominantly the coupon and a little bit of excess return, but it's incremental at best. You're sitting around earning your carry. And then finally, in that third phase is the neutral rate to the last cut. This is where most of the return happens, around 60, 61%, is after the Fed cuts rates down to the neutral policy rate. It's not a great thing that you missed the first phase and now you're in this phase two where you're clipping your coupon, getting an incremental excess return for the unknown period. But you want to own intermediate term paper, Andrew. Call it somewhere between 3 and 10 years of maturity and collect that coupon now and be set up or ready for very high excess returns potentially in phase three as the Fed cuts down to the neutral rate or goes below it.
So let's turn our attention to the stock market now, Neil. What do you think might be the most underappreciated feature of the stock market today?
Yeah, that's easy, Andrew. I label it quote unquote crash up risk. While everyone's always sensitive to market corrections or a potential crash, I truly believe they underappreciate how fast the markets are recovering after garden variety sell-offs,
Mm.
such what happened in early August and what is happening currently. Let me just give you two examples recently that to me are eye-popping, Andrew. Get this, on average, the NASDAQ 100 takes about 32 days to rally 10% after being technically in correction territory. In early August, it took 8 days, which was the fastest 10% recovery ever given those parameters. And then secondly, I think everybody with astonishment watched how fast the VIX spiked from the mid-teens all the way up to 65
Mm.
in record fashion, right? And this is another insane stat. Historically, once the VIX goes above 35, it takes around 170 days, or call it 6 months, to fall back below its median, which is around 17, 17 and a half. This time, Andrew, it only took 7 days.
Mm.
So I believe, Andrew, this crash up risk is a direct result of the amount of call option overwrite or buffered ETF strategies that have launched in the marketplace in the last 18 months. It's pretty saturated. And there are tens of billions of dollars of short stock hedges, now 5, 10, 15% above the market, that once the index blows through those barriers, buying begins buying. And it happens in a vacuum so fast. And what this really means, Andrew, bringing it back down to earth, is that for investors, time in the market is more important than timing the market. Meaning investors can't afford to gain that exercise and miss those top 10 updates of the
Right.
year, right? Where their total return is diminished by roughly half. And then for traders, I'm just going to be brutally frank because I've traded with the best of them. Good luck, Andrew, handicapping that type of violent whipsaw price action in a short period without twisting yourself into a pretzel.
Yeah. Neil, in the last couple of days, we've had the first debate between Vice President Harris and former President Trump. Where were the pressure points on stocks, bonds from the election, if any, from your perspective?
I knew you were going to ask about the election, Andrew. I know you couldn't resist. And so I'm going to keep these comments specific to the markets, no personal opinions here. For me, it's as an investor or portfolio constructor, it's too early to know for sure who's going to be the next president, what their policies would be, and to what extent either would undo current policy programs based on the makeup of the House and the Senate. Also, I would very much note the starting point for either candidate is very different than where it was in 2020 or 2016 regarding the deficit, the annual budget, and the level of where the stock market is and where interest rates are starting in this cutting cycle. So I think, Andrew, another way to think about it is focus on one big thing. And for me, that big thing is to watch fiscal policy, which to me is now the dominant structural driver. So people aren't familiar with this. The US is running a deficit, I think around 6 to 7% of GDP. That figure has only been exceeded in 3 previous occasions. One was during the pandemic when we unleashed massive amounts of stimulus. 2, back in '08 and '09 during the global financial crisis. and then way before I was born in World War II. So personally, I want to know if government spending will be higher than that, call it 5% of GDP, will stay at the 6 or 7% deficit level like it was the last several years. If so, that keeps the spending engine running. And if you think about that big picture, Andrew, it really doesn't matter who wins the presidency. The deficit horse left the barn. It ain't ever coming back. And that's how I think about it. Otherwise, Andrew, I guess if you had to narrow it down on a candidate by candidate basis, I think if former President Trump wins, I'm pretty interested to see how his tax cuts get extended given this new deficit profile. Remember, as a reminder, they're supposed to sunset in 2025 and so forth. And if not, what does that sunsetting of those tax cuts mean if he was to win and then roll back part of the Inflation Reduction Act through executive order or even legislation? That collision of not extending the tax cuts and rolling back the IRA, that collision is austerity, period. And then on the flip side of the pedestrian conversation is if Vice President Harris wins from an economic standpoint, and really depends on the makeup of the Congress. But if the Democrats are in control and she can increase the corporate tax cut to whatever that number is, call it 28%, I guess we have to take off about 5% of S&P earnings from models. Other than that, Andrew, I'm going to leave the politics to the gurus.
Let's switch back to the FOMC meeting. How does an investor position for the first interest rate cut, Neil?
So I like risk assets that are tied to lower real interest rates first, to super long duration, and then finally supposed to benefit lower financing costs. The three investments that come to mind and ones that we've been putting to work here at Rareview Capital in our portfolios is gold miners, number two, biotech, and number three, mortgage REITs. I call it, Andrew, my high beta carry basket. And I think that's the clearest cut version of how to get started. I'm less certain in the short term, given the degree how much interest rates have already fallen, the fact that we have phases in that regarding that asset class. And then in currencies, the responses to the first cut are a bit more ambiguous. And so I don't want to put a lot of high conviction bets around that. I think equities are good. And I think you should stick with lower real interest rate ideas, super long duration expressions, and lower financing cost investments.
So finally, let's turn to Berkshire Hathaway. They've seemingly got a large stockpile of cash these days, or they've been selling, and the notable name in the news has been Bank of America. They've been selling down the positions. What's your takeaway from that strategy?
That's an interesting question. You throw me for a loop there, Andrew. The pedestrian view is that they're building cash reserves like they always have ahead of an anticipated recession to go shopping at discounted prices, as he would say, like a kid in the candy store, right? Or maybe, Andrew, they just had too much concentration risk in specific companies, right? They just need to bring that down so there's more diversification at their side. And it's probably most likely on an ex post basis that will end up being the case when people study this period in a decade. That said, Andrew, since you asked me that question, I do have an off the beaten path view, or what I would like to call Neil's market conjecture. So let me think about that for a minute. So Mr. Buffett owns, I think, about 37 or 38% of Berkshire shares, and they're probably worth, I don't know, 140 billion, 150 billion, somewhere in that neighborhood now based on today's prices. And I think they stockpile around 250 billion. And I know they like to have about 100 billion on hand at any given time. And if you just think about this progression, so he's 94 years old. Unfortunately, he just lost his longtime partner, Charlie Munger. Here's my question. What if Berkshire just buys back Warren Buffett shares in one large $140 billion transaction so the stock can't be diluted after he's gone? Now, before anybody says anything, that can't happen, I would just like to remind people that Mr. Buffett has a phone call, most likely, probably more than anybody else as a non-official, into this person called the U.S. Treasury Secretary. And I'm sure they can find a solution to the estate planning and tax ramifications that the IRS can live with. So I'll leave it there, Andrew, but that's my conjecture.
Brilliant. My guest today has been Neil Azous, CIO and founder at Rareview Capital. Many thanks, Neil, for joining me.
Thank you as always for having me on, Andrew, and best of luck.
It's always a pleasure. And don't forget to subscribe wherever you download your podcast from. Thanks, Neil.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. The information in this podcast does not constitute tax advice and cannot be used by the recipient or any other taxpayer to avoid penalties under any federal, state, local, or other tax statutes or regulations, or to resolve any tax issue.